Hello, welcome. Can you hear us in the back?
Yes.
Okay, well, welcome Temple University, Japan. It's not our penultimate event, it's our pre-penultimate event of the year. So we thank our loyal members for their presence and their activities during the year. I'm extremely happy to have Nick Banish, who has been a Japanese resident for quite some time. I don't know how many years.
28.
28 years. It's a little more than me. And who's an investment banker and who is also the founding director of the Board of Director Training Institutes of Japan. So he will obviously speak to us about corporate governance. I think it's an extremely timely topic. We actually decided to do this before Olympus. So Nick, without further ado, the floor is yours.
Thank you.
Thank you very much.
Thanks very much, Robert, and good to see you all today. I'm going to mix this up a little bit and sort of go through some of these points in sort of reverse order. I guess the best way to start is this way. There's such thing as corporate governance culture, and I think the Asian Corporate Governance Association defines it pretty nicely. They have various categories whereby they assign rankings or scores to different countries. A score of 80 would be what they call a world-class market score.
Let me say a word.
Yeah.
It may be a little difficult to look in the back to see the numbers. There's space available in the front, so you shouldn't have to you don't have to backbench it. I don't think Nick is going to like call for you, and if he does, probably he will call in the back.
I have halitosis, but it's not that bad.
So
That's what I think it would. Anyway, these scores will show you that there's various categories, rules and practices and GAAP and so-called regulatory rules structure. And then they have culture. Well, that's everything that's not in the rules. Everything that companies are, or investors are not required to do by the rules in terms of compliance, but they do anyway. Say investor relations or engagement or simply talking amongst investors, etc. Or we do, any of this kind of stuff. Training that's not required, but you do anyway, is corporate governance culture. And it is a very low score for all markets in Japan, right across the board. And it's what's dragging down the average score of every single market in Japan. So you have to sort of ask, why is this? And it does have an impact in terms of performance. The overall corporate governance score of each of these markets, if you look at individual companies, does to some extent correlate with their performance. If you cut out the guys with the low scores, you get better performance. So corporate governance culture has certain common characteristics that have a lot to do with the tendency for Asian cultures to look at things in a vertical hierarchy way, respect authority, respect elders, and that sort of thing. And also the fact that a lot of corporate governance, shall we say, structure, laws, or other paraphernalia was sort of imported from the West, and they didn't create it themselves, so they don't feel like it's really theirs. Also, you have a lot of founder-controlled companies or listed subsidiaries, kind of thing. Now, I want to go through a very quick example of how changing corporate governance culture, whether it's Olympus or anybody else who may talk about it, is a very hard thing to do. Here's a certain company, and it had some compliance problems and reporting problems and shoji, sort of scandals, and it decided it was going to increase its corporate governance or improve its corporate governance system a lot, increase the size of the statutory auditor board and add more outside statutory auditors. And they announced a whole list of other things they were going to aggressively try to change their corporate culture to stress ethics and compliance. And these are all actual pronouncements that they made in their PR and IR things. And you can see all the words here. A system for climate of individual responsibility, building mutual trust, make every effort to respond or restore public confidence, safety and quality control, internal and independent audits, etc., increasing confidence, reforming our corporate culture, reestablishing the existing corporate culture, systems to ensure the observance of ethics, etc., and they took concrete measures. corporate standards for ethical behavior, a long, well-known code, organizational structures for implementation. These were organizational changes they made. They established a corporate ethics committee. There were nice charts like this of what the ethics committee would do. It was composed of outsiders. And why did they do this? Well, because they had misconduct and they wanted to reform themselves. Now, if you know who this company is, don't answer the question I'm going to ask next. Who does anyone think this company is? It's a real company. Any ideas? Give me 5 ideas. Go ahead.
Snowbrand.
Snowbrand. Okay. Anyone else? Let's wait a while again. Go ahead.
Toyota.
So Snowbrand, Toyota. Who else?
Citibank.
Citibank. Could be Citibank. Well, I don't know. I'm not. I didn't say that. Okay.
Olympus.
Olympus. Anyone else? Go ahead. Yeah, that's a good one. Yeah, could have been, right? Well, it's not, folks. This is TEPCO. Okay? It's TEPCO. The company that, I'm not sure exactly why, but was the company that was in charge of 3 meltdowns. Now, I think we'd all have to say that if you polled most Japanese citizens and you asked them whether all this stuff was very successful in terms of really reforming the corporate culture and the attitude towards transparency and maybe ethical attitude or safety and all the things they're talking about here, and was that reflected, secondly, in the attitude the company showed when the crisis took place and its organization. I think a lot of people here, regardless of my opinion, in this country would respond that they don't think this was very successful. So you have to sort of say, well, why wasn't it successful? I'm going the wrong way, aren't I? Here we go. Sorry. But your answers show the most interesting thing here. That the important conclusion here is that it's not an event. The problem we had at TEPCO is not something specific to XYZ, to TEPCO. It's a systemic issue. Because I just asked who this could be, and I got 4 or 5 different answers. And I've done this about 10 different times. And I've got probably a total of 15 or 20 different companies in all those answers that people give. And actually, very rarely do I get TEPCO. It's quite interesting. Despite the number of people who say about TEPCO, oh, well, that was just TEPCO. They always had a bad corporate culture over there. They always liked that. I mean, that's a very special industry. Well, I don't really agree. Now, what would you have to do to change that corporate governance culture successfully? Well, clearly, what they did was not, in the view of many people that we call them, I think, that successful. You have to, in my view, bring in a lot more outsiders. They had an inward-looking, insider-driven company. 18 out of the 28 board members were internal hires who'd come up through the ranks. The outsiders they had were, specially picked folks. There was one guy who was, more you might say, individualistic. But this was not a board that had a couple risk management experts and somebody from the French nuclear company or a foreigner, anyone at all, of diversity type, a woman, somebody with outside nuclear or energy experience, with a diversity to sort of say, hey, wait a minute, I come from a different background, and in my country or company or my experience, risk management might be done a little bit differently. Let's look at that more closely. You would have had to bring in outsiders not only on the board, though, but in the executive ranks and as consultants. And you would have had to have training programs that weren't something you created by yourself, just so you're kind of making your own test and then scoring it yourself. That's how most board training occurs in Japan. So a lot more outsiders. Now, I go through this presentation and I talk what investors could do, and I really wanted to ask the question of their investee companies. What are you doing about board training? Is it provided by an outside specialist provider? Because obviously you, the semiconductor company, your core competence is not composing and designing board training programs that fuse management, law, and compliance and corporate governance theory. So it's not your core competence, so are you using outsiders? And how many hours does it include? Is it 4 hours by your well-known law firm? Or is it 2 days that include a lot more topics that are important as well, like succession planning or strategy, risk management, the subject of board oversight, including the law, compliance, and the governance topics. So I believe, and I formed this organization because I do believe, that training that strengthens the knowledge in the middle ranks and allows not only board members to know more about their own legal obligations and liabilities, but also the middle ranks to know what theirs are going to be 10 years from now, and what process and governance they have to support, is the kind of thing in Japan, bottom-up organizations will hasten a higher average level of corporate governance quality. And this is not just pick on Japan. I think the world, to be fair, has a corporate governance problem. It's a global problem now. The only thing we've learned this year, with 4 different instances of QDEN and TEPCO and Dio Paper and now Olympus, is that Japan is not any exception and has a lot of stuff to work on as well. So who is BDTI? Well, BDTI is first of all, it's a Shadan Hojin, which is a association where the members are what correlate to shareholders. They call them members, Shain. And each member, which in our case, so far anyway, anyone's welcome to join, but each member is the board members here, has only one vote. And it doesn't matter if separately he donates a lot of money to BDTI, he only gets one vote. And I purposely chose this structure that will never get me rich. And I've given 60 million yen or something to this organization, so about $750,000 or so of my own money, and I'm not a rich person. But I've done that in a way which it can never come back to me as a dividend because it's a non-profit. Precisely because of the structure, I only get one vote. I can be kicked out. If other members come in, they only get one vote. If Steel Partners wants to give us $100 million, if Mitsubishi Corp does, if Nissei, that'd be even better, wants to give us a lot of money, they only get one vote. Which means we can never be assailed or accused of being led by a certain group, party, affiliation, foreigners, the Japanese, so-and-so, it doesn't matter. We're neutral. And the next part of this is we fought battles hard for the first year, that's why it cost so much money, to be accepted, to apply to the cabinet office and get accepted as a, quote, public interest corporation, a koeki hojin. Koeki hojin means that the activity that we focus on, which in our case is training with respect to corporate governance, or the dissemination of information, or a discussion forum about corporate governance related topics, this activity has been certified by the Japanese government as being in the public interest. And we're set up according to rules and regulations. Now, this is very important. And it was one of my initial goals when I set it up. And that's, again, another reason why I set it up as a Shadan Hojin, as a nonprofit. Because you can only apply for this status if you're that sort of organization. This was the first time in history that the Japanese government has ever acknowledged that training, knowledge about, or information about corporate governance is in the public interest, serves society and the good of society. Believe it or not, there are no rules, unlike most other nations, there are no rules in Japan, whatever, requiring board training, requiring corporate governance study by anyone, or even requiring disclosure of whether a company has a policy requiring it or not. I made a long list of countries and markets once to sort of confirm my own curiosity about this, but probably about 80% of markets in the world have some rules somewhere, whether it's listing standards, corporate law, corporate governance code, what they call soft law. Japan has nothing. So BDTI marks the historic fact that the Japanese government for the first time has acknowledged that corporate governance training serves the public, and information about it, education, serves the public interest. This is a grassroots organization in the sense that I've been here 28 years, that's the latter half of my life, I'm the only foreigner in it. We have an excellent group of advisors and board members. I've tried to be willfully, consciously, as inclusive as possible here because the reason why it says, for instance, board director in Japanese, yakuin, not Toshima yaku, but yakuin, is that we would like to train everybody who's on the board. That includes statutory auditors. They're board members as well. Because the board functions as an integrated group, and all members on it should be having a good understanding of where the other folks are coming from and what they think their role is. The internal guys should know what the external guys are supposed to be contributing, and vice versa, what they think their roles are. There should be a good understanding on the part of the statutory auditors about what their role is, and vice versa. And that can only be obtained, we can only get a more common toolkit of this understanding and consciousness if we all sit in the room together while we're trained. That doesn't happen in Japan now. To the extent you have very scant director training occurs after people are nominated and elected to be on the board, so it's really sort of too late to have much of an incentive. And that means when you're voting for them, they don't have the knowledge that they really need to sit on the board, which is sort of backwards. But to the extent that education does exist, in say 30% of listed companies, it's almost always an internal program or a quick outsource to our beloved law firm for 5 hours of boring legal lectures. And it exists in silos. So those programs I just discussed by companies are set up internally for their own inside directors, as it were, not the outside directors and not the concept. Concept or statutory auditors go to the Statutory Auditors Association, and they have programs there if they want to take them, but they're not required to take them. That occurs as a separate silo. The Japan Directors Association, JACD, or the Nihon Terjemaku Kyokai, has programs for outside directors. Shagai Net has some seminars, arguably, for outside directors. But nobody's integrating the whole board, and if you don't unite them, how can they be a group that efficiently knows how to act together, is my point of view. Having sat on a lot of boards, a lot, 4 or 5, I saw so many common characteristics. And two of the most common characteristics were that often the guy next to you is the head of sales, and he's sitting next to you, and his mindset is still the head of sales. He does not walk into the boardroom and think, I'm now a director. I think of stakeholders, shareholders from a higher level. I have liabilities and risks. I should know about the corporate law. I'm a director now, I'm putting different roles. No, he is still the sales director, and he's oblivious to the fact that he knows less about the corporate law than me. That's kind of a scary thing. The next thing that's kind of scary is the lack of sort of dysfunctionality in different people not knowing what other people's roles should be. They don't know what my role should be. I probably don't know enough about what they believe their role is to be to the extent they know that. The statutory auditor sometimes speaks, but it's clear he's not quite on the same wavelength. So you have problems like this. Now, I passed around, I'll get over the sales pitch and I'll go on to other content very quickly now. 2 things. One's a description of BTI and also a description of some of our recent programs so you get an idea of what we're doing. We have a 2-day director training course coming up on the 11th and 12th of December. If you speak Japanese, please feel free to sign up. There are still seats available. We do a training, and we have a bunch of partners, or quasi-friends, you might say. UCLA Executive Education is one, Deloitte Touche is another, White Case. This upcoming program includes speakers from Hitospachi ICS and GCA Savian and Monitor, etc. Professor Osugi from Chuo Law School. We offer programs at the middle management or even lower level, including an e-learning course, which is 9 hours, including corporate law and corporate governance, by Professors Osugi and Wakasugi, who are on my board. And we have this discussion forum. I urge you all to go to the discussion forum. It's very simple, bdtior.jp. Press register, and you can register yourself, and if you do that, you'll get a newsletter in both English and Japanese. It's bilingual, it's got an English and Japanese page both, and you can ask any questions you want about corporate governance-related topics, ESG, management-related topics, or just give an opinion or upload a document to the data library. You can search the data library and do all this kind of cool stuff. I would encourage you all, as you can see also on the other page you got, to make a donation. This would help very much. My wallet is running dry. In 9 months or so, 6 months, if you don't make break even, I'll have to shut it down, and Nick will go kind of quasi-bankrupt. What would help a lot is if everyone in the room could make a donation of 3,000 yen or more. Now you may ask, why 3,000 yen? That's because this fiscal year, if we get about 100 more donations, we have close to 100 now, so we need a total of 200. If we get 100 more donations, we should be able to qualify for an extra specially useful tax status. We're already tax exempt because we're koike-hojin, but the next goal is, and because of that, we don't pay tax, but donations are also deductible to us. But if we get this extra special status, donations will have a double tax benefit. They'll get, like deducting twice as much for most people for the next 5 years. So that's a very useful structure if you're trying to raise money from the public, which right now in Japan is just becoming attuned to the fact that corporate governance is essential to their society. So anyway, that's one presentation, and now we'll go over to another, if Nick can figure this out. That's a big assumption, isn't it? And I'd like to briefly go over recent, here we go, the directions of the company law amendment, and that'll I made a proposal about 11 months ago, well, 10 months ago, something like that. And this is an update of it. I still agree with my proposal, and this includes an updated information about what's actually sort of happened in the meantime, in fact, since 18 months ago. I don't know how many people know, I should have asked this before, I'm not very smart at these things. How many people knew, before Nick started talking about the amendment of the company law, that the Japanese company law was in the process of being amended? Can you raise your hands, please? So maybe 15% of you. Okay, see that by itself shows the extremely high level of public awareness that we are now amending one of the key codes of Japan that affects all corporations and these corporate governance topics that have direct relevance when we're talking about three meltdowns having occurred. I'm being sarcastic. Isn't it sort of amazing that we don't know this? And you don't know this, it's not just because you're foreigners that you don't know this. Most of the Japanese public, if we did this, because I do a lot of presentations in Japanese to Japanese audiences, most of them didn't know it either if I asked the same question. So anyway, about 18 months ago, the DPJ boldly announced in the manifesto, whereby I got elected, that it would plan to amend the company law for the purpose of improving corporate governance. And at first, that included the imposition of the requirement of outside directors. It took that out when the Labor Federation didn't like it so much and wanted to put an employee on the board. Said, well, we'll just obfuscate everything and take it out quick. But it all really started with this concept of having more outsiders on the board. Now, you can see some of my points here. This topic in Japan of what should be done with board composition, it has been sort of distorted, or should I say, affected by propaganda from the very start. And that's to say, there isn't another country in the world, US, UK, France to some extent, most of the Asian nations, most markets in the world really, that have put in effect rules requiring outside directors. In most cases, independence is defined somehow, for the purpose of improving company performance, operating performance. It's very difficult to prove that having, a majority of outsiders on your board, no matter how independent they are, as opposed to 4 out of 10 or 3 out of 10, marginally improved performance. I mean, just think about it. 1,000 different factors. The economy, the price of gold, whether your product inputs are cheap or high, or the volatility of this, cost of labor, affect company performance. To think that simply having more outsiders on the board is going to improve it and be detectable statistically is kind of a fantasy. And so it's not surprising that most studies show a marginal increase in corporate performance, maybe, but not that much, because they're trying to measure things on a 4 to 5 to 6, geez, one more beneficial, and that's a very debatable topic. the New York Stock Exchange came back after the recent crash and concluded that maybe we have too many outsiders on U.S. boards, which is probably a very true observation. There's a balance for every company. It's probably optimal. But economic studies do show, as you can see here, and this is by Professor Saito at Kyoto Sangyo Dainaku, Kyoto Sangyo University, that if you have one outsider on a Japanese board, there is an improvement, a detectable, statistically detectable improvement in company performance as a result of that. And that's sort of obvious to anyone who's ever sat on a Japanese board. Having one guy in the room who's not one of us, watching what we do, helps us be conscious of perhaps, zipping up our fly and being a little bit more conscientious. That sort of audit impact, just having a guy who doesn't maybe say much, who's watching us, is something that is just a very human nature. So anyway, the DPJ announced that we do this and then did absolutely nothing for the last, or the ensuing 15, 16 months in the way of the political guidance that they so famously proposed that they would do. And I know this because I've spoken to a number of people on the Ministry of Justice Committee. There was no political guidance. DPJ didn't have a clue what they were doing. Didn't really care. The committee was convened. Of course, the MOJ at this point, this is the third amendment in 10 years. MOJ is very phased, and their perspective, you can see here, is kind of like, gosh, do we really need to do this? FSA formed a corporate governance discussion group. I was a member of it. They led it so, I'll say it out loud, and this is on record, without direction. Let's put it that way. That a number of us were rather, I think, frustrated, probably 6 or 7 of us in particular, and I think it was mutual frustration because they really wanted to sort of suck a lot of brains, get information, sound smart on the committee, but that was it. There was no direction they were willing to go to. And sadly, it's not their fault. Their seniors at the political level don't have any commitment, in the FSA's case, towards this subject, so they had to keep their heads low. So I'm not criticizing so much, but this is the result. FSA, it's kind of sad that the FSA doesn't contribute more, though, because if you look at their establishment law, they have immense power. They are the logical agency in the Japanese government to take the fore and the leadership role in reforming and improving corporate governance in whatever direction it might go, because they have the duty, not just the authority, the duty to suggest policy, legal change, in order to protect investors. It's very clear in the establishment law. And METI, who is the party in Japan that historically has taken the leadership role for purposes of maintaining a role for itself, because we know that METI's role gets diminished if they don't find it somewhere, doesn't have anything like that in its establishment law. So I think it's quite interesting. FSA could have done everything that the UK FSA has marvelously done by comparison since the Cadbury Committee in the early 1990s. They could have done all that. They could have copied what the UK did in a Japanese context, but they've done nothing, even though they had this ability all the time. Now the MOJ started out this discussion, and as you can see, they kind of talked about these topics with respect to outside directors. But at the bottom, look at the bottom point. The memos, if you read the memos from the early discussions where they talked about outside directors the most, they didn't do the obvious thing. They didn't describe in detail foreign jurisdiction and why those foreign jurisdictions 30-odd years ago, starting with the US and then the UK, legally, what was the reason and the logic for requiring independent outside directors? They kind of almost, I think, willfully sort of avoided that because you have a number of people on that committee, famous professors whose names I won't mention, who know the history, or wouldn't have to read very much to review the history and understand that the reason why you have independent outside directors on US boards and then UK and then other countries' boards and it's spread around the world doesn't have to do with increasing or operating performance. It has to do with the subject of this presentation, which is constraining managerial self-interest. In the 1980s, you had a lot of junk bond finance takeovers, you had takeover defenses, you had MBOs, you had LBOs. You had higher compensation coming down the line. You had all these things where managerial self-interest was at the fore, particularly in the takeover world. At the fore, and combined with these transactions that affected corporate value a lot. I'm going the wrong way. Sorry about that. Well, let's stop here. And so the Delaware Supreme Court, in a number of cases, formed law over a series of 2 decades that essentially said that if you're going to do something that where managerial self-interest, self-dealing is potentially likely to affect a very important value-changing event, then if you put that out, and you delegate that decision to a group of members of the board who are independent, can actually make that decision in full good faith, then we're not going to question their judgment. And the business judgment rule, which means that if there's really any plausible, reasonable, good argument for why you made the decision, then you're not liable, will be intact and will protect those directors. But if you don't delegate such decisions out to a group of people who can exercise the decision in good faith, i.e. you keep it amongst yourselves and you, the managers, who are buying out the company in MBO and have an obvious conflict of interest, because there's a self-dealing or self-interest at stake here. If you participate in the decision, then it's kind of tainted, and if you're sued as directors, you're probably going to lose. And the Delaware Supreme Court didn't say you absolutely always will lose, but they said it in such a way that everyone was pretty certain you would lose. Because effectively the burden of proof would be switched on you. And the plaintiff suing shareholder would not have to prove that you did not fulfill your duty of due care, which is hard to do with the business judgment rule, because as you get taught in law school, you drive a truck through that. As long as you have a plausible argument for why you made the decision, you're fine. Instead of the plaintiff having to prove the case that you did not fulfill your duty of due care, you're going to have to prove that you did. And that's a different thing. That's much harder to do. So, directors didn't want to make that liability, and if they didn't know the law, all their lawyers in the 1980s and 90s went to them in the U.S. and said, look, if you want to do any of these things, have takeover defense, pay yourself high compensation, do an MBO in the future, etc. You gotta have to have a lot of independent outsiders on the board. I mean, I gotta tell you, to save your own skin and have freedom to do the things you want to do, you're gonna need that, so do it. And they took their advice, and that is the genesis of independent outside directors. It has to do with constraining managerial self-interest. So anyway, let's go on to what the company law is doing. That's the background. They never talked about it at the MOJ committee, is my point. And what they are talking about now is this mandatory appointment of one outside director as one possibility that they might propose. But then again, as you can see, they might not. They might propose nothing. And what's been on the, simmering on the stove, served up by Chief Chef Mehdi, who, by sort of default, because FSA isn't exercising leadership in this role, because it should, as the thing that they want to be the flag that gets waved as the success of this particular round of company law amendment is the Supervisory Audit Committee style company. Kansai Kantoku Iinkai Sechigaisha. That used to be called Kansai Iinkai Sechigaisha, but then they included the word kantoku. And if you read carefully, it means almost nothing. But they kind of wanted to make it seem that over the last 15 months they'd done something other than what they first proposed, so they snuck in the word kantoku and kind of talked about the topic more. But the reality is that this is something that almost doesn't deserve description, and it's really only there as a smokescreen to propose something so that the industry lobby here, the Keidanren, is not put on the defensive and facing a proposal to have, say a majority or 1/3 or 3 at least independent outside directors on the board. In other words, to distract attention from that very highly likely proposal, Mehdi very quickly, 15 months ago, put this smokescreen proposal in place and made a big hoopla about how it was going to increase and improve corporate governance. But the fact of the matter is, it's kind of a brain-dead, useless proposal. First of all, it's optional. We have 2 structures already for corporate governance, 2 models of corporate governance in Japan. 98% of listed companies are supervisory or audit committee, statutory auditor style companies, right? Statutory auditor style companies. Only 2% are committee style companies, which is a little bit closer to the American model. Now, the statutory auditor style company scheme doesn't require outside directors, as you know, and it has flaws that the statutory auditors, while they do have marvelous investigative powers, much stronger than anyone in the U.S. has. This is a strong point of the system, and what they call dokuinsei, which means they can each individually go out and just investigate individually whatever they want, even if the committee doesn't, other people in the committee don't agree that that should be investigated. However, they don't vote on the board. So when push comes to shove, you have these guys who sit at the board and can make statements and can influence the board, and then it's just great for them because they never have to take responsibility for what they just influenced. The way you get sued on a board is when you vote. So voting, conversely, is the brake by which we ensure you have good decisions, because if I have to vote for it or against it, that could determine how I get sued. If I never have to vote, I can say anything in the board I like. I mean, it's a really great position to be in. Well, that's the problem with statutory auditors. They are the guard dogs of Japanese corporate governance and compliance and that sort of thing. But they don't have the votes. When push comes to shove, they don't have a stick. Secondly, their functions are 2 things. One is audit of the accounting statements as a double check to the outside auditor and the internal accountants. And the other is what they call legal audit. So both of these 2 audit functions. Legal audit means ensuring that all the decisions made by the company, particularly the board, are legally correct and not violating the law. However, these guys, despite that, are not required to have any training, background, or knowledge, whatever, in either accounting, audit, or law. It's kind of mind-boggling, isn't it? Well, that's what we have to weigh up then. You have 2 structures now, and what Mehdi and MOJ, because they're just MOJ keeps his head as low as possible in this kind of process, and does what other people tell it to do, and tries to find a consensus. But that's their role. MOJ keeps itself very. Our role is to protect the sanctity and the clarity of the law, which is arguably the correct position, but it means the wrong people step up and be leaders half the time. So they're more sort of passive, as it were. And now, of course, this structure has been tabled by Mehdi, and a lot of political energy has been put into it as a 3rd option. So we already have 2 options that confuse people. And as you can just see, it just took me 10 minutes to describe this system. And most foreign investors don't understand the statutory auditor style company system, even after several, almost decades in a way. Most of them didn't know, if I would tell them wouldn't know about the investigative powers of auditors because they're so, statutory auditors, because they're so rarely executed, for instance. Now we have a 3rd system which confuses the markets even more and doesn't even get at the key issue of constraining managerial self-interest. So I propose something, well anyway, next step here. Most recent thing happened is because of Olympus, all of a sudden the DPJ woke up out of its 15-month slumber, kind of, I don't know, kissed by a frog or a prince or something, trolled Olympus, and ran to the rescue and formed a working team. And the last 3 weeks or 4 weeks leading up to the MOJ's impending proposal for its midterm proposal for how to change the law, all of a sudden the DPJ was going to examine not only the company law, but all areas of law and regulation, including company law, securities law, and audit practices, which is kind of a tall order for people who didn't do much at all. particularly in the political guidance area that they said they would, for the last 15 months, despite all these events happening in the meantime, and despite being the guys who started the whole process. Having said that, there's some very sincere and constructive members of the working team, and I've taken a call for something, bully to them. They seem to want to push for requiring one or more outside directors. I think at the end of the day, what you're probably going to get is one outside director. And my question is, I've been in that seat. You have to really be stubborn, really fight a lot to get 20% of the impact that companies deserve in a pinch. You know, what can one guy on a board of 10 do? But create a lot of noise, make himself hated, and put it in the minutes and vote no to protect his backside, and not get elected ever again by that company. That's really what you're making the guy do, and expecting him to do. And expecting Japanese people to do that in a consensus-oriented society, it's not used to open debate and that sort of thing as much as some other societies, is just, you know, fantasy. And so what we're going to have here is, even if we have one outside director, it doesn't accomplish an awful lot. Is he going to form a committee of one to look at the MBO? Well, that violates the general principle of the board, which is that group decision-making is supposed to be better than you know, single guys. But you need to delegate, as I said earlier, these decisions out to a separate committee, because otherwise you're deciding the CEO's compensation and the pricing of his MBO with him sitting next to you. That doesn't work very well. You're going to get influenced by him, et cetera, et cetera, et cetera. He votes, but he outvotes you because there's, you know, 8, 9 of them and 1 of you. So we need the ability to not only form committees and delegate decision-making to them on these issues of managerial self-interest that are binding on the board, but we need more than one outside director in the first place to form the committee so there's group decision-making. So I guess I'll stop here because Robert warned me to try and do it in 30 minutes and open it up for questions.
Well, thank you very much, Nick.
Sure.
This is, as you mentioned, unlike a Japanese board, this is a place that's open to discussion and questions. Maybe we could also turn on the lights. Speak up. So we'll take the first question. Just identify yourself. And no questions? Okay.
Nick, thanks for the comments.
If you could identify yourself.
John Riley.
Okay.
What has been the response from the institutional investment side in Japan? You know, you mentioned Nisei and the pension fund association. To what you're doing, you know, your drive to institute these type of reforms.
Well, what I proposed here, I didn't explain this, but I might explain it now.
Could you talk into the mic, please? The mic?
Sorry. Yeah, sure. Well, what I proposed 10 months ago was that you have companies, in other words, Japanese companies and the Keidanren have positioned this argument that you know, companies should select for themselves what the best corporate governance system is. And this is sort of, if you permit me, infected the general consciousness because they've been saying it for so long and nobody can agree about what the best structure is, so they can kind of use that confusion to their advantage. Okay, I said, fine, okay, we'll let you choose. You can choose. You want to choose, fine. Your selection. You can choose to have 3 independent outside directors on your board, and you can even choose to entrust these matters relating to managerial self-interest, or not, and decisions about those matters to the committee of such 3 people, or not, as you like. And I even used a section of the existing code, which is called a special board, which exists for other purposes, but you can use the structure to avoid having to go through the painstaking difficulty of creating committees of boards in Japan, which is legally a difficult topic that people here have sort of, shall we say, because of the way they're trained and the law is already structured, so they're not used to. They have difficulty accepting it. So I said, fine, okay, we'll use the special board concept that's already in the code. We'll just copy it as is. It's very useful and it accomplishes basically the same thing. That gets better because it's a board decision itself. It's not just a committee decision. So If you use this committee with those topics I described, then the business judgment rule will protect you as it normally does on most other decisions. And if you don't, that was your decision. You didn't have to use the special board. We're going to do what Delaware law did in 1980, 85, etc., and shift the burden of proof on you, effectively. Now, I mean, Delaware law is a little bit different, but it's effectively that. So, and that would give companies an incentive to say, well, gosh, for these decisions, I could be sued. You know, the wrong MBO price, exercising, triggering a takeover defense, etc. I want to put it out to the independent committee, so I'm going to need these independent guys in advance. And that's really how Delaware law worked until, you know, Sarbanes-Oxley, and that was the first time we actually required independent outside directors on U.S. boards. And it would work the same way. And companies, this is basically accountability 101, you know, because it's all up to you. And as long as you can explain and defend, you're willing to defend your decision in court if it comes to court, and be accountable for it, fine. Take your pick. Don't have the 3 outside directors. Don't have the independent board. That's what I propose. Now, what's been the feedback? I showed this to quite a few members of the MOJ committee, including the head. I've given this presentation in Japanese to a number of groups. Lawyers tend to understand my proposal very quickly because they understand burden of proof and why this works logically, and they say, yeah, that's a pretty interesting idea. They don't say much more than that, but privately that's what they feel. I think anyone who studied the law would have a similar reaction, because that's a very logical sort of framework. And if you know much about the genesis of independent outside directors, it fits. Everyone else has very studiously ignored this. And when the first time I gave a large presentation about this to my study group in Japanese, the head guy at METI, who's in charge of marshaling the company law process, never comes to this meeting almost ever, but came to that meeting and spent half of it sort of lambasting me and trying to throw curveballs, which basically most of them showed he hadn't even read the proposal very deeply. So, but he wanted to kill it as dead as possible. So that's my feedback so far. What's the next question?
My name's Larry. I'm from Seattle, Washington, in the United States, and we had a bank there called Washington Mutual, which was the largest savings and loan savings bank in the United States. Until it went bankrupt about 2 years ago due to engaging in excessive, highly risky lending transactions. Of course, the CEO of the corporation is a very, very wealthy man who no longer needs to work. Mr. Edano, who's the head of Susanshi, I think has a general reputation as being quite a liberal politician. He was quoted, I think, yesterday at the FCCJ to say that corporate governance in Japan is better than corporate governance in the United States. And
I think it's as good as, or
I think he said better.
maybe better.
I mean,
Were
maybe
you there?
I was not there. I just heard this second. But of course, if you study the United States, you think about something like the Enron Corporation, which had a board of directors, in which I think maybe 9 out of 11 were outside directors, including the spouse of a congressman who was the head of a regulatory agency in the past. But of course, all of the outside directors were picked by the CEO. And the board of directors, the independent board of the Enron Corporation, failed to identify all of the fraudulent transactions that were taking place. And the role of the corporation really was to maximize the income of the CEO and other senior officers. And so, what's the point of all this? I mean, what you're proposing is really something based on the American model. And what we've seen with the American model is it fails. So what's the point? I think most people are really interested in economic performance. They're interested in high quality goods and low prices. But perhaps Mr. O'Donnell's right. In fact, there is less malfeasance in the executive suite in Japan than there is in a place like the United States. What do you think about that?
I don't care about it. That's not the point. This isn't a music I get on, you know, a fight with water pistols or something where we're comparing I'm taller than you, or you know, I have a bigger gun than you, or the corporate governance worldwide is in a very big rut, a melees, groping in the dark for the next phase of its evolution beyond the stage of Neanderthal. We're at the Neanderthal stage in governance evolution, where each system has its pros and cons and strong points and its weak points. And the reality is we shouldn't be sitting here comparing apples and oranges and saying, you know, my water pistol is a little bit bigger than yours, when the fact of the matter is they're both tiny. That what we have in the world, in any country, well, no matter who it is 5% of what we need to aspire to. And let me explain what I mean by that. So arguing that I have 5% and you only have 4.8 is kind of pointless. That's really the relativity at stake here. The problem the world faces now, in my view, is that if you think of this in terms of graphs, I'm going to explain this 5 days from now in our director training class, and it may get confusing, and I apologize if so. But if you think in terms of graphs, you have one line that's going up at an accelerating rate, which is the technology line. And technology has exponential, expansive qualities, which mean that this is very good for society when it works, but when it creates nuclear radiation, it can create massive damage. So the ability of economic activity to create massive damage is going up at an exponential pace, which is very fast. And the ability, even if they work perfectly, corporate governance systems to keep up with the risk management and the control of that potential damage that ever increasingly large corporations can create is not going up at the same exponential rate at all, if it even is exponential at all. And so these two lines are diverging. And we have a massive issue in global society of the high chance that we've already seen occur in the last 20 years, i.e. an increasing frequency of very large damage-causing externalization of risk events, that some of which led to mass public bailouts and huge damage, whether it be the Enron in the markets or the TEPCO with radiation, or the Lehman and the EIGs and the financial market, you can go on and on. BP, you know, all these are externalization events. And just as I'm saying, I believe very strongly that the curve of soft human capital, knowledge of corporate governance, and the processes and structures for it are just at the Neanderthal stage and are not keeping up with the ability of technology to destroy the world. And so for us to sit here and argue, hey, this is based on the U.S. system and that sort of thing, you know, is it going to work at all? We have to make it work. We have to develop something that is a lot better than the U.S. One of the reasons why the U.S. doesn't work as well as it should, and people are losing trust in markets, and that's something of great concern, I think, to you as well, I know from your background, is that when they see things not working and people being overpaid despite that, anybody can sort of stand, it doesn't have to be a rocket scientist to say that doesn't quite figure, right? And this distrust in markets is not a healthy thing. We have to recover it. When they see public bailouts and their own tax dollars going in that direction, they think. So what I'm doing here is I would never copy the U.S. system in all its respects. It's got a lot of bad aspects. I mean, one of the bad aspects in the U.S. that we're not able to solve in the last couple of years is access to the proxy. Japan has excellent access to the proxy. You don't have to own many shares at all to propose me or him or anyone else to be on the slate, the board slate, and appear in the proxy materials. It's a very healthy rule. It's been in place for decades. Most Americans don't know that. In the U.S., you can't do that. If you want to propose Robert here to the be on the board, and management doesn't like your selection as a shareholder, management says, I'm sorry, his name will not appear in the proxy materials, and you're going to have to spend $1.5 million in a proxy battle to try and win by buying newspaper ads. And that doesn't work very much, so nobody does it. It's very costly per stock you own, right? The other thing that the U.S. has in spades, obviously, is the executive compensation problem, which distorts a lot of decision making, as we all know. And Japan doesn't have that problem, because you require AGM approval of aggregate director compensation. So every system has its strong and weak points, and we have to learn from each other. And that's why I'm trying to encourage and facilitate cross-border interaction, discussion, trading information more. And that's why I think that the level of understanding of how these systems are supposed to work, that we should aspire to, is very necessary to cultivate, and that can only be done through training. The number of market players, board members, investors, etc., who don't know enough about the basics of corporate governance, corporate law, and the theories behind how this is supposed to operate, is surprisingly small, despite the rhetoric that they utter all the time.
I think I may be able to help you with this one, at least. I'm Peter Fuchs, and I am a research analyst for American investment funds and I visit 100 companies a year and talk to board and managers. Larry's question sounds a bit odd to me because, or his statement, because it's a bit like comparing the Constitution, which has enormous number of checks and balances in the United States form of government, and that say, in Russia, where Mr. Putin rides roughshod and gives the appearance of having a succession when he puts his own man in as president to warm the seat for him. I mean, clearly, both of those countries will maximize their self-interest, but I think I'd rather live in one than the other, and I think the same could be said for a system of corporate governance that has checks and balances preferable to one that does not. And it's the old question of the agency problem. Owners have to appoint agents to run their companies, and they have to keep check on those managers to not have this excess self-interest, and that's going to be a perennial problem, as it is in politics, to make sure that systems function well. So checks and balances are generally always better, because corporations, especially those with listed shares, are in fact large public entities that affect social life, welfare, economics, growth, and people's savings. So all companies now have a very highly public character, and therefore they have to have these checks and balances, because a Kaicho in Japan is a former Shacho, and next year he'll become a Mayo Kaicho. And at Canon, a brilliant manager such as Mitarai-san will appoint a sort of, a Russian-style deputy to run the company while he's doing all his Zaikai activities as chairman. And later on will become, and so on. Many years ago, Toshiba Machine, by the way, sold some complex machinery in violation of export rules. And METI saw to it that the chairman and the president were removed, and or something like that. And I asked someone who knew about this, and he said, well, this was actually a very severe punishment, because if they were removed from their positions, they would never be in position for an award from the emperor, a kunsho. And so it was far more a severe punishment than most people understood. Okay, but if that's the real system, that you're a kaicho in order to get a kunsho, and you can't get a kunsho unless you get a kaicho, you can see why there's a self-interest in staying in that role. Now, my question, finally, is, some years ago there was this debate that the shareholders' interests are best served by having an independent chairman, and then he oversees the different committees, and he appoints the compensation, or looks over the compensation committee and these other committees. And it's very clear here that the CEO is appointed by the board, and he comes from the outside. So you have an independent outside shacho system in many parts of the United States and Europe, where in fact the board has very strong control. What has ever happened to that notion in Japan, that the shacho can actually appoint a shacho who has been a brilliant guy in the aircraft industry or in the food industry? I'm sure it's dead, but how dead is it?
Well,
the notion of a stronger independent board, with a chairman who may well be an outsider and has a position to really oversee the CEO.
The concept of an independent lead director who fulfills a chairman role, or a chairman who behaves independently, even if he rose to the ranks of the president, doesn't really exist here. If, to the extent the chairman is active, he ends up being a god type, 3 months ago. I don't mean that critically so much as that's quite common, right? When he is active, he's really the de facto CEO, right? So it's either one or the other, as you know. And this is not surprising because we, for better or worse, we live in a country where the aversion, the extreme distaste and intense effort to avoid any rules requiring outside directors, let alone independent outside directors on boards, even in numbers of one. They're proposing 1 out of 15 people be an independent outside director on the board. And mind, the MOJ doesn't even say the word independent in their materials. They just say outside. Okay. They're strengthening it a little bit, not only as little as they dare, or as much as they dare. The notion of having just one of those guys who's outside and a little independent is revolutionary in this country. So in that context, it would be about 10 times, just think logically, about 10 times more revolutionary for the top guy who's setting the agenda, facilitating, but requiring items to be on the agenda, to be totally independent. So that's not going to go anywhere fast unless a lot of other things accelerate. I guess the reason why I'm doing this BDTI thing, as you know well, Peter, is that I got to the point where, and I think Mr. Rapetta asked me a question of what's the point. That's a great question. That's an excellent question. I got to the point where I've been doing a lot of policy advocacy on themes like this for a long time and thought deeply about the issues and sat on a lot of boards, so what went wrong. And I realized that even now, with the minimal amount of structural and legal changes that they have made, the soft human capital aspect, the knowledge to really put that into effective place to execute that structure the way it was intended to achieve the purposes, the goals intended, is not keeping up with the structure. So if they make more changes, and that will probably accelerate in the next few years, whether it's quasi-American or French or UK or a mixture, which a mixture could be good in many respects. I'm not tied to the U.S. system; it's a lot of faults. But if it accelerates anyway, the human capital has to be in place that understands government issues and logic of how the system is supposed to work, or the structure doesn't function. It's just a lot of diagrams and boxes that we saw, other people put together and don't work. Sorry, you had a question. Go ahead.
Hi, Nick. My name is Ricky. I thank you for your sharing. Personally, I very agree your work and promoting corporate governance. My question is, does Japan as a society, do they want that? Anyone need that? Company is part of the society. Are we just the 1%? I give you my 2 observations. A while ago, months ago, I was in a Nikkei management conference in Tokyo. Very senior president of a Japan company talking about leadership and governance. And the first slide he showed is Japan has over 500 company, has 200 years history, while US probably has less than 50. Germany similar, China similar. So his message is, we have been doing that for couple hundred years, and we are fine. And you also, I think I pick up from your line that is, Japan is a consensus-oriented society, and by bringing independent director, I think one thing that the whole objective is to create debate and check and balance. Is this something a consensus-oriented society they want?
We'll see. We'll see. Who's they? I think the they that you're referring to are the managers themselves. There's no society that has made reforms or improvements to corporate governance in its laws, system, where the managers wanted most of the changes. I defy you to name one. The Business Roundtable in the U.S. is not happy when the SEC proposes access to the proxy, fought tooth and nail, spent a lot of money, and won. So when you say, they, just like any other modern society, they, the managers, don't want any of this stuff, for the most part. Frankly, they would like to do corporate governance changes, and that's not saying that they're poor managers or don't agree with any governance, but they'd like to be able to have total freedom to do just the parts they deem necessary. That's a lot easier. What about the Japanese people? I don't think it's possible to talk about corporate governance without making the obvious observation that it's a part of sort of civics that you would study, or you should study. I probably should have studied more in high school. The whole issue of how society should be governed is sort of an umbrella in which corporate governance is a sub-part, because it's the state, which, as you know, in history, the sovereign government gave companies the right to form corporate status and have limited liability. This is something that the state extended historically in terms of the evolution of the law to people, and that's how corporations were first formed and why they're able to have limited liability. And of course, it's limited liability which is the major reason why you can raise a lot of capital, because you, the shareholder, are only going to be liable for the money you put up. And we can't sue you for even if you're a TEPCO shareholder, we can't sue you for the damage caused by the radiation beyond the money you put up. You're just going to lose the money you put up and no more. That limited liability creates a huge, massive capability to raise a large number of dollars, or yen, or whatever it is, and invest it. And that's been the effective aspect, of course, of the corporate form for the last 200 years or so. But with that goes an incredible ability to create damage and loss, and then walk away having externalized it onto society, and you pick up the mess. And that's what's happened with Lehman, AIG, TEPCO, etc. This is all part of civics and general governance, and I think you're seeing sorry to be taking so long, but you are seeing a shift in the tide in Japan towards more awareness of governance, civics, governmental regulation issues overall. And I think the increased interest, if you will, in the wake of so many events that happened this year in corporate governance will just accelerate. It may take more time. Things take more time in Japan for in the public mind and the media to sort of get educated and move on these issues. But when people here read the newspaper a lot, as you know, and they study hard when they get going, and then things can accelerate a lot faster. And I think that probably will happen over the next 10 years. David. I'm sorry.
I'm sorry, I'm still a PhD student, so my question might be very simple.
Could you speak up? I'm sorry, I'm an old man.
I'm still a PhD student, so my question might be very simple. I would like to know if you mentioned in your proposal something about the regulation of wages according to manager and director in the context of the regulation of the labor market, the temporary law enactment. And I'm not talking about, but I would like to mention also the Amakudari system in Japan and the lack of transparency between business and politics, as you may know.
So I don't mention anything about the labor law in anything that I do, is the first answer to your question. I guess you're asking, do I have any comments on Amakudari?
any comments or any suggestion about the regulation of wages accorded to manager and directors?
What's wages?
Wages,
compensation.
Wages.
Yes.
Oh, so are you referring to the inequality debate nowadays? The gap? Well, I think one of the in general, relative to the U.S. and to a less extent Europe, excellent aspects of Japanese corporate governance culture is, and in fact the corporate law here, is that the company law requires that the total amount of aggregate compensation to directors be approved by shareholders in some way, shape, or form. So you either approve it at the AGM every year or every other year, or it's in the Articles of Incorporation as a cap amount beyond which you're not allowed to pay. You simply may not pay all directors as a group, more than whatever it may be, 600 million yen or something each year. And this, maybe involuntarily or inadvertently, results in very effective sort of a break on excessive executive compensation, because 80%, 85% of Japanese boards are nothing but top executives, they're internal boards, so it is the management group, which is not the case in the U.S. The only guy on the board, often in a U.S. company, is the CEO. So if you had the same rule in the U.S., it wouldn't accomplish an awful lot. It would just cap his, or even him, he would just take most of it, basically, in the U.S., let's be honest. And this system has, you might say, worked too well. So if you look at pie charts of executive compensation for Japan, Europe, and the U.S., you have one which is, say, a factor of 15 or 20, and that's the Japan, maybe 20, Japan pie. And then you have one which is 50, 60, and that's the Europe pie. And you have one which is 100, which is, in terms of different size pies, the U.S. And that's the difference in CEO, particularly CEO compensation. I'm talking mainly about now, because that's what they compare. And if you look, therefore, at the way the pies break down, this is very interesting. The amount of cash compensation is a percentage of the total pie. This huge pie of 100 in the U.S. is not so much, 25% like that. And as well as other things, which are many times variable compensation of one form, or options, which unfortunately are variable, but it's kind of get lucky and not necessarily linked to performance that much. But the number of options is, so you can argue both ways. But anyway, it's variable to some extent, whereas the Japanese pie is 75, 80% cash and fixed. And so the weakness of the Japanese compensation system now is it doesn't offer enough alignment with shareholders' interests in terms of variable compensation that's linked to performance-linked compensation. And so, I think that would be a very healthy step in Japan, is if slightly more active investors were to go around to Japanese boards and say, well, look, we'd like you and your middle managers to have a little bit more upside in the game, as well as downside, and to be able to buy stock in the company and own it, or have linkage in your compensation to operating profits and that sort of thing. So in order to, we'll approve that if you propose it, as long as you have, say, 2 or 3 independent outsiders on the board who will compose a special board to police the system and make sure it's being properly executed. As a trade, that would be very, I think, beneficial thing. David, you had a question, sorry.
David Satterwhite with the Fulbright Commission here in Japan, but also on the board of TUJ. First of all, Nick, we've known each other over a decade, and I applaud where you've come with the overall migration of your own efforts, very much along the lines of what we see today.
Thank you.
And also, I applaud the broad historical sweep, putting it within the historical context of where the global market economies and so on have come from and appear to be going, or need to be going. You started out with a dramatic case of not knowing the company, and it turned out to be TEPCO. trying to bring about some changes in its corporate governance. And I suspect the audience is very big today precisely because of the issues of this year, whether it's TEPCO or most recently Olympus, that we're all really fascinated, riveted, needing to know and understand more, and what is the direction of this. We're riveted by the negative or the scandalous behavior when it comes out. Are there some best practices, some firms in Japan that really stand out as leading the way in extraordinarily good corporate governance along the lines of what you described? Are there any firms that are doing the kind of training that you've described and therefore actually Jinzai Ikuse, in the sense of bringing people into an improved understanding and conscientiously doing that? And the reason I ask is it's riveting to see the negative cases and the scandalous behavior, and then we form stereotypes, whether it's the Exxon in the US or 20-some years in Olympus here. But to be able to chart the way of those that are doing well, and then along the lines of the Kyoto Sangyo Daigaku professor, to be able to show the results. In other words, best practices equal the next step of a company actually doing better because of that.
Well, we did a poll of sort of internet service of Japanese companies, and when you do that, it includes a lot of unlisted companies, but we had a group of listed companies as well. And of course, you never know exactly who's responded, but the result of this poll was that a surprisingly low number of listed companies had any programs at all, and that may be just because the ones who responded. I'd say, as a rough guess, though, if you look at the top tier of Japanese companies, the top 1,000 market caps and TSE or something like that, probably 40% of them have an internal program of some form or another, and it ranges. Mitsubishi Corp and these kind of typically trading companies, because they have a lot of affiliates and they have to send middle managers out to be on the board of things. They have a lot of people they should be training for sort of Dio paper type purposes, because affiliates are something that require good board knowledge. They have some reasonably good programs, as I understand, and do call up some outside people, and they go off for a day or two and together with general managers and have a program. Whether it's the same kind of program that we're putting together, I think it probably excludes a good deal, because ours is very broad on the U.S. director training model, a la what I've learned from UCLA, which includes, as I said, strategy and risk management, M&A, succession planning, as well as the topics that you should know for compliance and anti-corruption and governance theory and that sort of thing. Kind of fuse these. How should the board really practically work in order to oversee those other topics? And by the way, here's the knowledge you need to know substantively about those topics in order to oversee them in the first place. Here's the leading edge of management theory. I don't know if they go that broad, but they make probably a pretty reasonable effort. But it's not a large number of companies that do that. The other group you have in this maybe 40% or whatever it is, the top GSE 1,000 firms. They're those that either use the Keidanren's corporate director training program, which is sort of mainly outsourced to Nishimura, the law firm. So you go to a series of what sound like rather boring lectures about corporate law and compliance and what you need to know about securities law to avoid insider trading. Mainly what you need to know is, of course, to call Nishimura when you get in trouble and you hear this kind of thing happening, XYZ. So most of the other programs are, they have something inside maybe, but maybe nothing, and the rest of it, they call up their local their favorite law firm and have them give, 6 hours or so of rather boring lectures that are restricted, limited to compliance and legal angle, which is important stuff, But it doesn't lead to an active strategic board where you're going to have a little more exchange of opinion and second opinion. What are we missing? The inclusion of outsiders, and it doesn't include, as I said earlier, all members of that board, or as sort of types of people. So you don't have the chance to sort of mix shoulders with people from other companies who have other experiences, who are going to be outside directors or staff directors, and understand everyone's role in advance. You're all of a sudden, on a board, and the only people you can train with are people who are just like you. So I think there's an inherent limitation, even no matter how smart Mitsubishi Corporation is, by the very nature of the fact that training is, is an education-oriented thing that requires a lot of input. I don't claim to be doing it. I don't know if I'm doing this even 20% perfect the first time, but we're going to focus on it. We are going to specialize in training and learning each time to do it better and getting other speakers who are better, and this sort of thing. And that's the kind of practice they don't get. And that's only the top tier of the, the top 40% or so of the very top tier companies. We have, 4,000 plus listed companies in Japan, and I would say probably the vast majority of them don't have any training at all. And that's the real problem.
So therefore, any best practice cases that you might point to?
Oh, I'm sorry, I didn't ask that. Yeah.
And the reason I...
There are companies that are doing a good job in corporate governance. Shiseido or Eizai or Sumida. Sony's not doing a bad job, of course, too. Not everyone may agree, but I think you could, on a relative plane, you go down a list, there's probably 10 other companies that would come up to mind if people know this stuff. Follow the companies in detail, like the proxy advisors. But it's not an extremely long list. What do you think, Peter? You look at companies a lot. What do you think?
I specialize in small cap companies where the founding family usually owns 40%, so it's a very different story. The larger, more global companies tend to have more effective governance. Honda, and these Panasonics, the household names tend to be very good because they have to be. In the auto industry, for example, you're so regulated that's hard not to be.
Right. Good point. Yeah, I guess my major point is that, I don't know the exact stats because to actually understand everyone's corporate governance training program, you can't. But I think the main point to be made here is there's huge diversity in Japan, and it's probably just going to increase. Those people who, are forced by either their own excellence or the competition they're under to keep up and improve, and have a sort of global standard in mind, learn from others because of it, versus those who we don't have those influences, and the divergence between them is going to accelerate.
Hi, Sid Feinleib, Rikyo University Graduate School of Business, Management and Technology, now retired. I can see from the conversation that's been going on over here that there are three kinds of checks and balances. There are the government checks and balances, there are the internal board of director checks and balances, and the outside auditors for the checks and balances. So these three different entities exist already, and whether they're functioning properly or effectively is really the question. I can see that, for example, the government has its checks and balances very seriously on taxes and financial kind of situations, health and safety issues, or the governments come in and bring in auditors to check to see if your laboratory and factory are up to the correct standards and regulations of safety for the general population. The other checks and balance have to do with the outside auditors who come in and look at your financial books, but now they're also coming in to look at the corporate social responsibility, which is a more amorphous kind of auditing, which is possible and maybe closer to the auditing of governance. And so I can see that the government can bring in its own external auditors. For example, in the nuclear industry, there was a recommendation that French engineers come in to look at the Japanese nuclear plants, and people from different countries come in and arbitrarily, without any obligation to the people they're investigating, to make sure that their power plants are up to snuff from an international point of view. So with these three different groups of checks and balances and auditors, the government, internal board, and outside audit, I get the feeling that you're emphasis here is on the one one aspect of bringing in the external board member who may be the liaison to the external auditing firm in a broader sense of social responsibility and governance. Is my analysis a little bit close to the truth?
No, it's not. I'm sorry.
Okay.
I was asked to explain developments in corporate governance in Japan, and I don't want to bore you with all 100 hours of the Olympus TV traffic you just listened to over the last 2 months. So that's not the development we're focused on. I focused on the much larger issue that so few people are unfortunately aware of, that one of the most important laws that decides the corporate governance structure in Japan is now under amendment, and sort of nobody knows about it. But I have been trying in the last 12 months to do my part to help it improve as much as little old Nick can. I believe that the amendment of the company law is a possible turning point for Japan. It'll probably miss the turning point again. But I think it's a development that deserved discussion, so I discussed it. But what I do at BDTI is not to push independent outside directors in an organizational sense. I have my own opinion. When I give lectures, I'll explain they're good to have around for these reasons. It's your choice. You don't have to agree with Nick. This is how to use them, how they can be more useful. I teach outside directors as well as inside directors. 15% and 85%, hopefully, these guys. If the inside people hire us, the companies hire us. But the major target here, is, that's what I'm trying to say, the corporations. For their managers who are promoted to the board or as executive officers. That's the larger market. Those are the guys who need the most training, as we just discussed, because we have a lot of companies that don't have any training or insufficient outside sort of new perspective and that sort of thing. And so, no, and we're going to say, when we give the course in a few days, one of the first slides I have is, hey, this is not religion we're talking about here. This is about you, who may be a director someday, understanding that when you do become one, if you do, what your liabilities and risks are going to be, and how to act, and how to start thinking about that role, and how to prepare your mind for it, so you can study more and discuss with others, and be ready when the time comes, which may be soon, to do responsibility for something, a job which is extremely important to society and to our future generations on an individual basis. This is something that you, the individual, if you're going to take the job at all, have a duty to the world and yourself to do the absolute best of your ability and understand it's not the same thing as management. So that's the kind of thing we're going to be teaching. And in that context, it's not just to push independent outside directors. No. Does that make sense? Because most of the boards here are not independent outside directors. You're going to improve Japan, and you can't focus on Japan. So.
Thanks. We have time for just one very short question and a very short answer. Okay, so a short question. That's good.
Maybe I missed it in the beginning, but are the seminars and
Can you speak a
e-learning?
little louder?
Maybe I missed it in the beginning, but are the seminars and e-learning available in Japanese and English?
Only Japanese now, but it's quite fascinating. I get more people interested in the e-learning for English. They if you only had it in English, than I do in Japanese almost. It's really quite interesting. So if anyone, you came in late perhaps, so I'll explain again. I'm encouraging everyone in the room, and I'm confident, I'm going to get a hit ratio of 90% out of the room to make a donation of at least 3,000 yen or more, so that we can qualify for a better tax status next year, and I can maybe get a salary 5 years from now. But that would help us make a product in English, and I would like to make one because a lot of Japanese companies have the problem, they've gone global so fast and so much that they have all these foreign managers who may not be on the board, but they're executive officers or the presidents from foreign subs and this kind of stuff, and they need to know how the Japanese legal system works and what they're feeding into or part of in the corporate governance sense in terms of duties and liabilities. So we already had a course we gave for a leading Japanese company. They wanted in English, like for those people particularly. That is definitely needed.
Thank you. Thank you very much, Nick. I think you've managed to tie both the corporate governance issue to broader political, social, and philosophical issues. So this is a really perfect presentation. And as you saw, you had more people in the audience at the end than at the beginning. So they must have heard about it and decided to walk in. So thank you very much. Again, you have, first you have Nick's presentation, the 2 PowerPoints, as well as a form to donate and to join the Institute. And if you didn't get an invitation directly from us, just give me your business card. I'm Robert Bijarek, by the way. I run ICAST, or to Madeline or Walter over here. And our next event is Friday. We'll talk about the role of the Japanese self-defense forces in peacekeeping overseas. And next week, we have a presentation on the movie Cut with the director and with Engin Yedinudia, who many of you probably know. So thank you again.